Greetings, listeners of Stock Explorers, and welcome. Today we're doing a focused exploration, a real deep dive into Target Corporation.
Yeah, Target. Big name, obviously. Everyone knows them. A major player in retail.
Absolutely. And we want to assess its current position, for potential investors. We'll be looking at recent performance, key factors, the whole picture.
For sure. It's a huge presence, nearly 2,000 stores.
Yeah.
And they sell, well, pretty much everything. Understanding their place in today's market is pretty crucial.
Exactly. So our goal here is to really break down Target's business model, look closely at the latest financial results, the good and the not so good.
And figure out what might help them grow or what could hold them back.
Right. And ultimately pinpoint those key milestones that you, as investors, should really keep an eye on. We want to give you that comprehensive view. So let's just jump right in with the latest news.
Okay. So their first quarter for fiscal 2025 just wrapped up, and honestly, the results showed a pretty significant shortfall. They missed expectations.
Right. Net sales, I've got the number here, $23.846 billion. Sounds big, but it was actually below what analysts were looking for, wasn't it? Around $24.35 billion.
Yeah, exactly. So a miss on the top line. And importantly, that's down 2.8% compared to the same time last year.
Okay, so a bit of a backward step on revenue. What about earnings?
Same story there, really. The adjusted earnings per share, the EPS, came in at $1.30.
$1.30. And the forecast was, what, closer to $1.65 and $1.65?
Yeah, in that range. So $1.30, quite a bit lower.
Yeah.
And compared to last year's $2.03, it's a drop of about 36%.
Wow, 36%. That's definitely something to look at. Now, I did see a GAAP EPS figure of $2.27. That seems much higher. What's going on there?
Right. So GAAP is the standard accounting method. That higher number, the $2.27, was mostly because of a one-time gain they got from settling a legal case.
Okay, so not related to the core business performance then.
Yeah. Not really, no. It makes the GAAP number look better, but if you want to understand the underlying health, you really need to look at that adjusted EPS, the $1.30, and maybe even more telling, the core operating margin was only 3.7%.
3.7%. That strips out those one-off items and gives a clearer view of just how the main business is doing.
Exactly. It shows the fundamental business faced some real pressure in Q1.
Okay. So, a challenging quarter overall. But let's shift gears. Were there any bright spots, any positive elements coming out of this?
Yes, there were. Despite the overall sales dip, their comparable digital sales actually grew by 4.7%.
Oh, interesting. So online is still performing well.
It seems so. It suggests their online strategy, their digital channels are connecting with customers, and that's, increasingly important. It shows they can integrate digital and physical effectively.
That's definitely a positive sign. And I heard something about their same-day services, like pickup and delivery.
Huge growth there, yeah.
Yeah.
Order pickup, drive up, and shipped. Those services combined jumped 36%.
36%, wow.
Yeah, and a lot of that seems tied to their new Target Circle 360 membership program. It looks like customers really value that convenience, that ability to shop across channels easily.
Makes sense. Anything else on the positive side?
Well, they also mentioned lower inventory shrink in the quarter.
Shrink.
Yeah.
So less theft and damage.
Exactly. Any reduction there helps the bottom line, improves profitability, suggests maybe some better operational controls in that area.
Good to hear. And any internal changes aimed at improving things?
Yes, actually. They've set up this new Enterprise Acceleration Office. It's being led by their Chief Operating Officer.
What's the goal there?
The idea is to make the whole company faster, more agile, more efficient, streamline operations. If it works, it could really boost performance down the line.
So a focus on efficiency. What about what they're actually selling? Any shifts in merchandise strategy?
Definitely. They're bringing a lot of new, lower-priced items. And they're also expanding their own brands, the Target-specific labels, especially in essential categories like groceries and household goods.
Yeah. That sounds like a play for the value-conscious shopper, which seems pretty timely right now.
Absolutely. It makes sense given the economic pressures many consumers are feeling. They're also continuing to diversify where they get their products from.
Moving sourcing away from China, you mean?
Yeah, continuing those efforts. It's about reducing the risk from potential tariffs or supply chain problems. It's a prudent, long-term move.
Smart. And for investors specifically, anything about financial stability stand out?
Well, Target has an incredible track record with its dividend. They've increased it for 54 years straight.
54 years. That's impressive. Shows a real commitment to returning cash to shareholders.
It really does. It signals stability and a long-term focus. And finally, they did see some strength in specific product areas, too.
Oh, yeah. Like what?
Things like women's swimwear did well, performance apparel, toddler clothes, seasonal stuff, books, even produce and floral. So not everything was down. Certain categories held up quite well.
Okay, so a mix then. Strong digital growth, good same-day service uptake, focus on value, dividend history, some definite positives. But as we started with, there were clearly some major challenges. Let's dive into those negative aspects now.
Right. The headline negative was that overall comparable sales decline of 3.8%. But when you break it down, the drop in comparable store sales was much steeper, 5.7%.
Oof, 5.7% down in the physical stores. That really shows where the main weakness was. What's driving this miss on both revenue and earnings?
It seems like a confluence of factors. Definitely slowdown in discretionary spending, people cutting back on non-essentials. Consumer confidence isn't great overall, which impacts willingness to spend.
Makes sense. Any target-specific issues?
Well, yes. The controversy around their DEI initiatives last year seems to still be having an effect, potentially through boycotts or reduced traffic from some customer segments. And then there's the ongoing uncertainty about tariffs, which adds complexity.
So a tough mix of external economic factors and some internal brand perception challenges. How did this hit their profitability, their margins?
The gross margin tightened. It fell by 60 basis points to 28.2%.
Right, the drop.
Mostly because they had to increase markdowns to move inventory that wasn't selling quickly. Plus, fulfilling all those digital orders while growing actually costs more.
Right, so digital growth comes with higher fulfillment costs, squeezing the margin a bit. 60 basis points might not sound like a lot, but on their scale.
Well, Leslie, it adds up to a significant chunk of potential profit. Shows the pressure they're under.
And what about their operating costs, SG&A?
Those actually went up as a percentage of sales to 21.7%. That's mainly because sales volume was lower. A lot of those operating costs are pretty fixed, so when sales drop, they eat up a bigger slice of the pie.
Got it. Now, inventory. You mentioned lower shrink, which is good, but what about the total amount of inventory they're holding?
Yeah, this is interesting. Despite sales falling, their inventory levels actually increased compared to last year. They ended the quarter holding $13.048 billion worth of stuff.
Higher inventory with lower sales. That's usually not a great sign, is it? Could mean more markdowns ahead.
It definitely could. It suggests they're having trouble selling through merchandise. And yeah, that often leads to more discounting later to clear it out. Something to watch.
Definitely. And you mentioned leadership earlier. Some changes there.
Yes, there have been some significant departures at the C-suite level, including their chief strategy and growth officer. That kind of high-level turnover can create uncertainty about future direction.
Especially if that person was maybe seen as a potential future leader.
Potentially, yes.
Yeah.
It just adds another layer of uncertainty for investors.
Okay. And how are they doing against the competition? Are they keeping up?
Well, according to Target themselves, they're only gaining or holding market share in 15 out of their 35 merchandise categories.
Only 15 out of the 35. So they're losing ground in more categories than they're holding steady or gaining in.
Seems that way, yes. It suggests they're facing real competitive pressure across a broad range of their business.
And the competition is fierce, right? Walmart, Amazon.
Absolutely. Walmart's huge in groceries and value. Amazon dominates online convenience. Costco has its loyal base. And then you have the off-price guys like TJ Maxx really appealing to bargain hunters. It's a tough field.
No kidding. Any other operational headwinds worth mentioning?
One thing is the potential impact of their own anti-theft measures. Locking up more items in cases.
Yeah, you see that more and more.
Right. It might help reduce that shrink we talked about, but it can also make the shopping experience more frustrating for customers. If it's too annoying to get help to unlock something, maybe you just don't buy it. It's a tricky balance.
A definite trade-off there. Okay, and finally, they lowered their guidance for the full year, didn't they?
They did. They're now forecasting a low single-digit percentage decline in total sales for fiscal 2025. And adjusted EPS is expected between $7 and $9, which is down from what they previously guided.
So lowering expectations. And I think I saw some analysts pointing fingers at Target itself, not just the economy.
Yeah, some commentary mentioned company-specific execution issues, suggesting that not all of this is just the external environment.
Okay, so a pretty clear picture of the challenges. But despite all that, is there a path back to growth? What are they actually doing to try and turn this ship around?
There definitely is a potential path, and they have several strategies in play. That Enterprise Acceleration Office we mentioned is key, the push for efficiency and speed.
Right, streamlining operations. And the merchandise changes.
That focus on value, bringing in low-priced items, expanding their own brands and essentials, it's all aimed at attracting shoppers back, especially those feeling squeezed financially. It's about relevance.
What about digital? They seem strong there already.
They're leaning into it. Continuing to invest in Target Plus, which is their marketplace for other sellers, Roundel, their advertising arm, and pushing that Target Circle 360 membership. The goal is a seamless experience however you shop.
And are they giving up on physical stores?
Not at all. They're still planning to open new stores and remodel existing ones. Plus, they're looking at tech like AI to help with things like inventory management and maybe even personalizing offers for customers, both online and in-store.
Okay. And the supply chain diversification we talked about, that plays into future stability too.
Absolutely. Reducing reliance on China helps manage tariff risks and potential disruptions. It could lead to more stable costs and maybe allow for more competitive pricing down the road.
Management seems pretty confident they can navigate this, at least publicly. Does that matter?
Well, management confidence is one thing, results are another, but their underlying financial strength does give them the resources to actually fund these initiatives, which is important. You need the ability to invest in a turnaround.
True. And just looking ahead, could things get a bit easier just because the comparisons get easier?
That's possible, yeah. The second half of last year saw sales declines too, so the year-over-year comparisons in the back half of this fiscal year might look a bit better, even if the underlying improvement isn't massive yet. It makes the numbers look less stark.
So strategy, investment, maybe some easier comps. There are ingredients for a potential recovery, but it all comes down to execution, right?
100%. The plans sound reasonable, but they need to translate into actual improvements in sales, margins, customer traffic.
Yeah.
And, a little help from the overall economy wouldn't hurt either.
No doubt. Okay, so for listeners watching Target closely, what are the absolute key milestones, the main things they should be monitoring going forward to see if this turnaround is actually taking hold?
All right, several key things. First, watch for real evidence that the Enterprise Acceleration Office is working. Are they getting more efficient? Faster. We need tangible results, not just talk.
Makes sense. Proof of progress. What else?
The comparable sales numbers are critical, especially store comps and how those discretionary categories are doing. Are those numbers stabilizing? Starting to pick up. That's huge.
Absolutely top line. What about profitability?
Keep a very close eye on that gross margin trend. Are they managing markdowns better? Are the costs of digital fulfillment getting under control? We need to see that margin pressure ease up and hopefully start expanding again.
And inventory levels, given that recent buildup.
Exactly. Watch those inventory numbers. Are the new systems helping them manage stock better? Are they avoiding big buildups that force markdowns?
How about the digital side?
Track the growth and performance of Target Plus, Roundel, and especially that Target Circle 360 membership. Is it driving loyalty and sales? That's key to their omnichannel future.
And are customers actually responding to the new value focus and own brands?
Yeah, that's crucial. Are these changes actually bringing people in and getting them to spend? Look for signs of improved traffic or basket size related to these initiatives.
Market share is always a big one, too.
Definitely. Watch those market share trends across their different categories. Are they starting to win back share in some of those 20 categories where they were losing ground?
And the supply chain efforts.
Look for updates on how well they're mitigating tariff impacts and adapting the supply chain. Does it seem to be helping their cost structure?
Anything related to leadership?
Given the recent changes, yeah. Any further leadership shifts or any clarity on CEO succession planning would be significant for investor confidence.
And zooming out, the economy.
Absolutely. Keep an eye on consumer confidence numbers and general economic indicators. Those will have a big impact on spending.
Finally, any specific times or events to watch?
Performance during key seasons like back to school and especially the holidays will be really telling. Also, listen closely during their quarterly earnings calls for management's own assessment of progress on all these fronts. And watch for updates on their capital spending and if those investments are paying off.
Excellent. That provides a really clear roadmap for what investors should be tracking. So to kind of wrap up our deep dive here, what are the main takeaways on Target right now?
Look, Target's in a tough spot currently. Declining sales, squeezed profits. It's a mix of wider economic headwinds and some challenges specific to them. Their digital side shows strength, but the physical stores are a real concern. They are making strategic moves to turn things around, but success isn't guaranteed.
And execution, as you said, is everything, along with maybe a little help from the economy.
Precisely. So for you listening, it comes down to closely monitoring those milestones we just laid out: sales, margins, inventory, digital growth, market share, execution. That's how you'll gauge if Target can really get back on a path to consistent growth and profitability. It's definitely a watch closely story right now.
Great summary. Thank you for this really thorough and insightful deep dive into Target Corporation. For everyone listening to Stock Explorers, we hope this analysis gives you valuable perspective for your own investment considerations. Please do remember to subscribe, give us a like if you found this useful, and hit that notification bell so you don't miss our next deep dive.